Hello, everybody. I'm Alfred Edmond Jr., Senior Vice President and Executive Editor-at-Large at Black Enterprise. Glad to see you here at our Future of Financial Services Summit. And what I have is our financial advisor, certified financial advisor, Michael Grove of Greater Metro Financial Group and a Prudential advisor. And again, we're not giving you individual financial advice. You need to talk to your own expert or your own professional for that. But we do want to have a conversation around what should you be thinking about when you're looking at cryptocurrency as a new asset, potential asset to invest in. Michael, I'll be very transparent. This session was my idea because as a financial journalist, and we heard about when Bitcoin hit the scene and everybody was excited about it 6, 7, 8 years ago. And as a financial journalist, I kept being asked, should I invest in Bitcoin? And my answer would be, yes. Then they say, how much? I was like, I don't know. It depends. So what I want you to do is just talk in more of a general sense about what should you be thinking about when you look at any asset class. You shouldn't put your money all in real estate. You shouldn't put your money all in, any particular asset class, whether it's Bitcoin, stocks, bonds, whatever. But talk about what the wisdom is around investment success over the long haul.
Hi, Alfred. Hi, everybody. Thanks for having me. When you're thinking about your investments, you want to keep in mind what your goal is. So if your retirement's your goal, that's the number one goal. That, everybody's got a plan for their retirement. So you want to keep that in mind. So most institutions are offering traditional portfolios. So cryptocurrencies are basically being added into a portfolio that's not even in the same account. So it's kind of done, and so what was mentioned earlier is a good point that it needs to be incorporated into the same kind of portfolio management system, which it's not right now, and so currently, you have to kind of go and purchase your tokens on your own and then kind of add them into your portfolio kind of on the side. So that makes it difficult. So and a lot of people are a lot of advisors are not really working with people on this topic. This is a tough thing to do because basically you're going to help somebody manage some money that they have in another account and then you're adding it into the portfolio. So when you're looking at the different asset classes, like traditional asset classes, you're going to look at the correlation between those asset classes. And portfolio management's pretty quantitative. And so, but when you're talking about an individual and saving for retirement, you're not usually going to get into these details, about you're gonna if the person wants to invest in cryptocurrency, because mainly the cryptocurrencies come up mainly driven by the client. So because right now we don't offer portfolios that have cryptocurrencies in them. So so basically the client says I have cryptocurrency. A lot of times clients have cryptocurrencies, and then we try to help them manage it. And since it's kind of like a do-your-own asset class, it's like a DIY type of thing. It's a big challenge actually, and it needs to be improved. Like this because if you look at the behavior of the cryptocurrency prices relative to what other asset prices is, recently they're highly correlated. So when you look at you want to get something that's not highly correlated, to add something to your portfolio that is not correlated with like the stock market, basically, because you don't want to have something that goes down with the stock market. So this recent behavior is not good, but I mean the institutional adoption is happening. So definitely this is it's how it's going to play out.
It's the right time to start thinking about it.
Yeah, I think it makes sense for people that want to like be in this new. So first of all, I would consider cryptocurrencies as a speculative asset class. It's got all these issues that the previous speakers were talking about, the regulation and all this uncertainty. That's the reason why there's such volatility. And I wouldn't view it as a safe asset class. I would view it as a speculative. So when you talk about speculation, that's what you would add into a portfolio, like maybe a small amount. Like a traditional portfolio, you're going to be more heavily, obviously, in the equity market, the fixed income market, and then you would add in some other little little pieces like to it that would maybe add some additional return. So
when I talk to financial advisors, again, over the years, and again, as a financial journalist, we talk about, again, speculative is something that may have a huge upside, but also could have a huge downside because it's volatile. Not enough is known about it. There's not enough information about it, depending on the currency. And so usually when people ask me, I say, well, when you're talking about speculative, you're really talking about something less than 5% of your total. If you look at everything you're invested in, it really shouldn't be more than 2 to 5%. And this is for any speculative investment, not just crypto, because yes, there's a huge possibility for upside, but you don't really know enough. There's not, to be able to measure it. Like you said, regulations. We talked about just what we don't know yet about how this thing is all going to play out. One of the things that I discovered as I was preparing for our conversation, the latest Ariel Schwab survey of black financial behaviors found that among millennials and younger in the African American community, crypto is the #1 most popular thing to invest in. You're talking about younger African Americans are leaning really into it. Now, on the one hand, I say to myself, that's kind of a good thing because the younger you are, the more time you have to ride out the volatility and make up for anything that could go wrong. You have time on your side. But what do you think about the excitement around this new asset class?
Well, I would recommend to look for some education around it. So I think that they were mentioning earlier about some looking for, and I would look for to get your financial literacy, improve it. It's just in general, but relative to crypto, it's difficult to know where to get your sources from. But to look for an education about the asset class, and then also to work. I think to work with someone to help with it. I think might be a good idea, because the thing is that you're completely right that. It could be a good thing when you're younger, because you can kind of if you make a mistake, it doesn't hurt so much. But when people are in their 55 and they're 10 years to retirement, then it's a bad time to make a big mistake with your portfolio. So, but the thing is that it's also, when you invest your money, you're not trying to be Bill Gates. You're not trying to be like you want to retire. You got to keep that in mind. Your goal, right?
You want to be able to live.
Yeah, you want to retire and provide for your family and have your money last the rest of your life. You're not trying to become $100 million. You want to get you pass some money to your kids and things like that. So for when you work with individuals, you want to get them to kind of spell those things out and then tie those things to your investments. So if you're planning on you're planning on retiring in 20 years or 30 years, maybe you can have a higher speculative allocation, because maybe you're okay with that. Maybe you could have a lot of times investors are going to they want to have more of their assets in a speculative investment than maybe what an advisor would recommend. So it's always you can't we can't this is not really part of the portfolio that we're managing for people. So it's kind of that needs to kind of happen, I think, to make it easier for the asset class to be managed as part of the portfolio. And I think that maybe that's going to help, but in the short term, I guess this is it's a big challenge. I mean, it's not it's and I guess Amari was saying, or Larry was saying that's where the opportunity is. I mean, the thing is that I would keep in mind that you want to look at your overall asset, your overall portfolio, and kind of evaluate it together. And not, might not have too much in cryptocurrencies, I guess.
So if I hear what you're saying, right now, the way the industry is structured, it's going to be necessarily outside of what your traditional portfolio might be. But you can say, okay, if I look at what I have in crypto or what I have in these digital currencies, and then look at what I have in the rest of my investment portfolios and put that together in one, I can figure out what the percentage of that is and you kind of get an idea whether am I overly invested, am I under invested. But the challenge, I guess, there is that you kind of have to do it on your own as opposed to, having it managed through your main portfolio.
Yeah, all financial institutions have aggregation tools that'll pull your accounts from different institutions, so you can look at all your assets together, your portfolio. But it doesn't connect to your tokens, your wallet. So it's got to be done. Right now it's done outside of that, and I would say that's right there is something that would help people to, if that was incorporated, because right now like I said, it's not really included, so it's basically done outside. So when you think about your investment portfolio, most people have the biggest amount of their assets in their 401k or their retirement account, which you cannot invest in cryptocurrencies. So I would say that when you add this piece into your portfolio, you really need to think about it, because it's going to be, so you need to think about how you're going to allocate it. So it's not something that you should do without really kind of putting some thought into it and considering all these kind of aspects. So when you're saving, you obviously want to save and put money into pre-tax, so you reduce your taxable income. So if you have after-tax money that you can save, and you're going to allocate that to cryptocurrencies, then that could be something that you could consider. But a lot of times people don't have like the excess savings outside of putting 20 grand into their 401k, like they can't save any more money because they don't have the budget. So if you're putting cryptocurrency, if you're investing in tokens before you're putting money into your 401k, I would definitely not recommend doing that. So this is something that you would invest in after you're doing your typical traditional like retirement planning and investing. So that means you're putting 20 grand into your 401k, or assuming your plan allows you to, you're putting that much money. So if you can invest more after-tax savings than that, if you're in a good situation, that's a great situation to be in, then you can start to add in these other investments. But I would start with the traditional allocations first, because that's going to reduce your taxable income. You live in New York City, you're paying 11% state and local tax. So that right there is going to, sure, the cryptocurrency has gone up more than 11%, but there's no guarantee, right? So
The other thing that I heard in an earlier panel, which I think is important, is looking at areas where you can, again, not risk your main portfolio that you're, like you said, you're using to finance your long-term goals, retirement, and other goals. But, for example, if you do eliminate short-term debt, means you don't have to make those debt payments anymore. That could be money you could reallocate to a crypto, because just moving that from one thing to another without diminishing the performance of your overall portfolio. I mean, I think the point that you're making about if you take care of the basics of good financial planning, having your emergency fund, being maxed out on your 401k, having some other savings, both pre-tax and after-tax, a variety of vehicles across a variety of asset classes and options, then you go back to what was said earlier. You can not only be invested in crypto, invested in NFTs and other those things, and yes, over the long haul, if you bet right and it goes well, you do great. But if you lose it all, or whether literally or figuratively, because we talked about also the challenges of keeping track of it, no harm, no foul. You'll learn, but you won't put your financial future and your financial stability at risk. Yeah, I want to challenge you a little bit. And you say people aren't investing to become the next Bill Gates. I spend a lot of time on Instagram, and every day I get followed by, I'm sure there are bots that's promising me that they're experts on Forex and Bitcoin and crypto, and they can turn $1,000 into $20,000 guaranteed. And we know most people just delete that stuff, but they're not going for the 98% that'll just delete it. They're going for the 2% that says, oh, I'm down for this. How do you communicate, particularly to perhaps younger investors, not even just younger investors, let me not go there, less experienced investors, about the importance of really becoming broadly educated around investing before they zero in on any particular asset class as the silver bullet? Because there's no single asset class, even the established ones, is a silver bullet to, I'm going to become a billionaire, in the next, 10 years.
It's a challenge. So when you talk to an individual, and so an advisor's job is to talk to you about why you're investing, why you're saving this money, and what you're planning on spending this money on. So then you're going to save the money, invest the money, so that it'll grow, and then it'll be there when you plan on spending it. So that is a different topic than saying, is cryptocurrency a good investment? So it's more about the client. It's really about the individual. And so if cryptocurrency can fit in their portfolio, and like I said, it's usually driven by the client, it's a challenge to work with them. I would recommend trying to find someone that is willing to work with you, because a lot of advisors, I don't think that they're really open to helping people in this area, because it's just difficult. But so some advisors, like, if you're managing your own money, they don't want to work with you, because they're like, oh, you got to open an account with me and I'll help you, So, but the thing is that if you're managing your own money, an advisor should be supportive, right? So a lot of younger people, like they're more likely to manage their own money, because you're young, and like you said, you lose money and it doesn't hurt so bad. But when you're like getting close to retirement, you're more willing to listen to advice, because you can't afford to make a mistake. But so I would say that, if you find someone that you're comfortable with talking to, and that is supportive of what you want to do with your portfolio, because ultimately it's the client's portfolio. It's not the advisor's portfolio. So if you wanted to add cryptocurrency into it, your advisor should try to help you do that, even though he actually cannot do it for you. He should be supportive of that because that's one of your goals. So if that's one of your goals, to add that in your portfolio, then the advisor should talk to you about how much would be an appropriate amount, and how to do it, and how to manage it, and how to monitor it, because portfolios are monitored. There's a portfolio manager that monitors the portfolio, rebalances the portfolio. So, when you're doing your own transactions and things, it's a different kind of ball game, because you're kind of like in the driver's seat. You're doing soup to nuts. You're basically determining how much you're putting in everything. But when you're in a traditional like money management account, these portfolios are not meant to return like 50%, 80% in 1 year. So they're meant to basically provide a diversified portfolio, which is going to provide stability, provide returns, but they're not like invested in one stock. They're invested in a broad diversified portfolio. So like in this recent down pullback in the market, much of the pullback is obviously concentrated in this cryptocurrency area, and then like growth technology stocks. But overall, the portfolio has suffered, but it's maybe 15% or 10%, something like that. So it's not like you say, it's not going to go to zero, Mm-hmm. But so I would try to like add it into a traditional portfolio and make it work, and find ways to do that.
How should we, as investors in general and crypto investors in particular, how do you, put it this way, how do you manage your clients around risk and risk? Because on the one hand, obviously, people are looking at the potential upside of a new, asset class that is in time going to transform the way money is handled in this country and what investment options are available. We're not there yet. We're kind of on our way in different parts of the financial services industry. But on the other hand, there is this feeling of risk. I'm a baby boomer. I'm one of those people that I got a wallet. I'm watching this stuff. I've been watching it, for 10 years almost. But I'm like, so there's one side of you that's like, I don't want to look back and say, to my grandson, you know, I had a chance to invest in Bitcoin and I missed it. And that's why I couldn't pay for your college education. On the flip side, I don't want to be like, oh, I'm all in and this is, like you said, it's speculative. There's so much we don't know. How do you, talk to your clients around risk in general? Not just about crypto, but in general, finding out their risk tolerance and then being able to say, your risk tolerance is here, so you need to take that into account when you decide that you might want to be invested in this thing, whether it's crypto or anything else?
It's tough to quantify risk because it's a very qualitative thing. But we have surveys. We have like a little questionnaire and things, and it just kind of like categorizes people as like a growth portfolio or an aggressive growth portfolio. But really what that comes down to is if you wake up in the middle of the night and the first thing you think about is your Bitcoin account or your cryptocurrency account, then that means you own too much cryptocurrency. So like if you're that worried about it, that it's like impacting your sleep or your kind of like, that's an indication.
I mean, I'm not being sensitive. Sorry, excuse me. Go ahead.
Definitely. So those, when you talk about risk, is like, those are the things that are definite indicators that you're not appropriately allocated. So, because risk is, like there's so when you look at your account and you feel that, you look at that number and you're like, hold on a second, it went from 60 to 23, and that makes you, how that makes you feel, that's what risk is. So that's when you, so there's no real like way to quantify it, but so when you're talking to a younger crowd, it's a little bit more difficult to kind of like get into these risk conversations because younger investors, aren't real risk tolerant, a lot of times. Mm-hmm. So, but I would say that as your portfolio grows and your assets grow because you're saving more money, I would think about that when you think about, 10 years ago when I bought like cryptocurrency and then I woke up and it went from 60 to 23, and like I didn't feel so good about that. You want to think about that when your portfolio is like $1 million, like because you get when you're about to retire and your portfolio is like $1 million, that's what you're going to retire on. What if it went from, or say, let's say your portfolio is like $600,000, all right? So then you think back of today when your Bitcoin went from 60 to 23. Then you think, what if my portfolio went from 600 to 230? Then that's what I would say is the idea of risk is you can quantify it like volatility, like of your portfolio, but those things are not helpful to a typical client. They're not really interested in like the volatility of my portfolio. It's really the way it makes you feel, and that's really the thing is very individual for certain people. So what I would say is when you're young and you're accumulating assets, you want assets to be down. So it's a good time to invest now, right? Because prices are better. Because you're accumulating. You want prices to be high when you're retired. When you're 65 and you're going to retire, you want your price to be high because then you're going to start drawing down your portfolio. So I would look at the big picture like that rather than getting too focused in on like this, and the details. I would kind of keep a bigger picture, like and a strategy, a plan. You want to have a plan. Like I'm going to save money like on a monthly basis. I'll put it in. That's the way that most people accumulate assets and retire. It's not going to be like your one stock that you bought turns into $100 million. I mean, it would be great if that happened, but for like pretty much everybody that I've talked to is like the typical way. It's like you save money, you grow your assets, and you stick to a plan, and then so.
Do you think a strategy like dollar cost averaging is something that you could apply to?
That's fantastic.
Like
yeah, fantastic strategy. So dollar cost averaging is investing the same amount of money like each month or each week or something like that. So that strategy is great. Like especially right now because people are nervous and they don't want to put all the money in. So let's say you want to buy some asset, like could be cryptocurrency or could be a regular traditional asset, but you don't want to put it all in right now. Say you have money that you want to invest, but you want to invest it over but say you want to invest it by the end of the year, so you have 6 months. So you can invest like 1/6 every month, and that's dollar cost averaging. So it's a way to get the money to work, put to work, without putting it all in at once, because you're nervous that because
And of course, when the asset in this crypto is low, you're getting more for the money.
Yeah.
And if it's high, you're buying less.
Yeah. So your average price is lower. Yeah, yeah. So that's the idea, that you buy a little bit more when the average dollar cost averaging. That's a great strategy.
And I'm going to ask you a question that I didn't prepare you for. So, I understand if you got to think about it for a second. What was your initial reaction as a financial professional? And we talked about it from the standpoint of us being excited as investors. You're talking about an African American community that's looking forward to new opportunities to create wealth, ones that may be more fair than past types of asset classes that was talked about earlier, about the idea of transparency and everybody's buying at the same price. But as a financial professional, when things like Bitcoin and Ethereum started to emerge, what was your thought about what this might look like for the future of your profession?
Well, I was a bit hesitant, so I'm a bit more supportive of clients that want to add this to their portfolio. So I should say that to begin with, but I don't recommend it to people. So basically, it's usually the client says I want to do this. So then I'm supportive and I'll say this is what might work for you. But I think that I was a bit skeptical, because. It doesn't pay a dividend, it doesn't have any cash flow. There's no, so there's a lot of question marks around it. But, and also the behavior of it, the correlation to other asset classes and things like that. And over time, when there's more of data,
Right.
10 years or 8 years is not enough to really get a full understanding of it, especially given all the uncertainty around. But I would say though that the previous speaker was talking about the regulation that will, I believe, assuming that they make regulations that make sense. If they make total mistake in the regulation, that would be bad. But assuming that the regulations make sense, which I'm sure they'll probably figure it out, that's actually a good thing for the asset, because when things are regulated, people are more willing to adopt it. And so a lot of times people are like, oh, regulation's bad and stuff. I do not believe that. I think that it's actually really good for the asset class because it gives it a validity. If it gives it people are more comfortable getting involved in it. So I think institutional adoption of this asset class has already kind of begun over the past couple years. And so assuming that doesn't reverse, given the recent performance, I think that should continue.
And how important, I always tell people that the test of a great conference, seminar, session like this is what we do when we leave. In other words, you could say, oh yeah, it was a really interesting conversation, but we circle back to why we're even holding this event, this idea that we don't know what it totally is, we don't know where it's going to go, but we do know that we need to be educated about it, we need to seek out that education, we need to talk to professionals, both, again, in tech, in finance, in this case it's the FinTech Summit. How important it is for particularly young people, but not just young people, to lean into, I need to at least be committed to learning about it. Even if I'm not ready to put money into it yet, I need to commit to learning about it. Because that was, I think, the challenge for, I would say, my generation. I'll speak as a baby boomer. It's either I'm going to be all in or I don't want to know anything about it. And I think it has to be this middle thing that says maybe I'm not ready to be all in or in at all, but I do need to know about it. How important is it for all of us to really be committed to that?
Well, financial literacy is really important, especially because in the United States, retirement planning is all done by the individual. Most other countries provide a pension, things like that. In the United States, you're basically on your own. You make a mistake and you ruin your own retirement. It shouldn't be that way, but it is. So financial literacy is very important. I think that just in general, and then if you. So here's what I would say, that the blockchain, I don't even understand exactly what this means, but blockchain technology definitely is different, right, than actual token. So when you're thinking about investing, you're talking about buying the token. You're not really talking about the blockchain technology is something that can be applied to many different aspects of things. So I think that financial literacy is definitely something that we just the United States should emphasize more, because the way things are set up, it's basically put on individuals, and so I would say that it's definitely a good idea but it's such a complicated thing that to try to think that you're going to figure out like a blockchain technology is kind of like it's not necessary. When you're talking about your retirement, it's not that complicated. You don't have to make it that complicated. So if you want to invest some money into a token, that's a great idea, but put it in a perspective of your total portfolio and in your retirement plan, like your plan to save this money. If you want to buy a house, like say you're young, you want to buy a house, you got to come up with a down payment, so that's got to be in a taxable account, not in a 401k or IRA. So these are the things that it's the actual details of what account the money's going to go into, and that but financial literacy is something that we need to really improve on, and I think that.
I think the other point that you're making is that no investment should be made in a vacuum. That it should be tied to what are your short-term goals, what are your mid-term goals, what are your long-term goals, and we already talked about risk tolerance. That once you establish those things, then it's an easier conversation to talk about where I should put my money, what my expectations should be in terms of annual returns, et cetera, et cetera.
Yeah, what I would say is that an individual that's saving money to buy a house, to pay for their kids' college, for their retirement, they don't need to understand like all the. You're not like an institutional investor that's like buying, has to understand like each individual stock and things like that. You have to take a step back and look at your plan and your portfolio. You don't have to, find the next Amazon or Tesla. You just have to put your money in a good portfolio that's going to grow. It's not. You don't have to. You don't have to swing for the fences. Basically, you want to have a good plan. Do the dollar cost averaging. Put money into your retirement account each month, and do that consistently. And then your retirement, your 401k. That's gonna most people. That's what ends up being their biggest asset other than their house. And so that's I think that plan is so you want to when you're picking a portfolio to invest in, you're hiring a portfolio manager a money manager to decide on what to allocate in. So or at least I would recommend doing that rather than trying to when you're managing your own assets, it's not easy. So when you're buying your own individual stocks, that is. That introduces a lot more room for error, right? Because like if you go and put your money into a traditional portfolio, like I said, you're not going to have those types of returns where somebody Shopify is, I mean, you want to have a diversified portfolio, So I think that perspective is really key because and the advisor's job, the reason why you want to work with an advisor is because he gets you to talk about these things because you lose the what do you call it, the forest from the trees. You're looking for like
right. You're supposed to be looking at individual stocks or the stock market that day. You forget about what you're really trying to accomplish in the long run.
Yeah, you forget that you're saving this money to buy a house, and you don't want to put it into something that's going to be too volatile because you're going to use it for a down payment in 2 years. And if the market, if you know what I mean.
Yeah. But it seems like one of the kind of the positive or bottom line conclusions of this whole conversation is if we take care of the main event of creating a financial plan, an investment portfolio, and then you add in a commitment to investing something in crypto, let's say crypto for the sake of the conversation, as long as you're managing the broader portfolio, what happens in the crypto is not going to put your whole situation at risk. And so it's about the broader financial strategy of which crypto can be a part, not about crypto being your solution to achieving all of your financial goals and dreams.
Yeah, I guess sometimes like working with an advisor, maybe sometimes people are like, wow, he's going to try to make me lower the risk in my portfolio and things like that. But the thing is, you want to find an advisor. That's not always the case. It might be, but you know, like you want to find an advisor that's supportive of your goals. If you want to, you know, what I say call swing for the fences. That means having a concentrated portfolio, like the previous speaker was talking about. You want to find an advisor that's supportive of that and that will help you do that because you know it's you know, like given the recent performance, you know, like that it shows that you know, like it can be dangerous.
All right. Well, Michael, thank you so much, and thank you all for listening and learning from this particular session.